Hello traders. Today we are gonna talk about one of the most important topics in Forex trading. It's specifically on fundamentals, on interest rates, and why interest rates matter for Forex traders. So first, as we said in the video on central banks, it's the central banks that set the interest rate, the base interest rate in a specific country, in any given country in the world. So the central bank will adjust interest rates as needed, and the usual effect on the currency that a change in the interest rate has is that higher interest rates lead to a stronger currency, and lower interest rates lead to a weaker currency. The central bank will usually increase the interest rate in order to fight inflation, to fight higher inflation, and it will lower interest rates to bring more inflation into the economy, or to create more economic growth, to help the economic growth of the country. That's the basics of how the central banks decide on interest rates. Of course, there is much more to it, uh, but for the basics, that's how it works. Now, what's the most important thing to understand for forex traders is that it is not that the past changes in the interest rates affect the currencies, but rather it's the expected future direction of the interest rates of a specific country that will move that country's currency. So, for example, right now, the Fed, the Federal Reserve of the United States, is expected to sooner or later increase the interest rates in the US, and as a result, the US dollar has been rallying since 2014, since mid 2014, on the basis of higher interest rates, of expected higher interest rates in the US. The Fed only delivered one rate increase since that time, but since the market expects them to raise rates again in the future, the US dollar is getting stronger. The nominal value of the interest rates is very important for the carry trade. And the carry trade is when traders sell a low yielding currency like the Japanese yen, where interest rates have been zero for almost 20 years, for more than 20 years actually. And they buy a high yielding currency like the New Zealand or Australian dollars, where the interest rates have been the highest in of the developed world for many years, and that is the classic carry trade. So the bigger the difference in interest rates between, for example, Australia and Japan, the more that the traders will flock into that carry trade. For example, at the moment, the interest rates in Australia are 1.5%, so that's not that much higher. For example, a few years ago, the interest rates were 3% in Australia. As you can see, we have lower rates all over the world. So that's the basic things that forex traders need to understand about interest rates and how they basically move the currencies, the major currencies traded in the forex market. So talk to you guys in the next video. Thanks for watching.